Welcome to the deep dive. Today, we're going deep into the world of accounting.
Oh, yeah.
All those debits, credits, and
Yeah.
those fascinating accounting standards. We've got some excerpts from an accounting textbook, so
Yeah.
get ready for a journey.
It's funny, so many people think accounting is just dry, just number crunching.
Right.
But it's really a history of how we try to understand, financial decisions.
Yeah.
And it's full of twists and turns, believe me.
Well, just looking at these excerpts, we've got some interesting stuff here. We've got the rise of U.S. GAAP, that big shift in how companies account for those retiree benefits, even the ongoing debate of historical costs versus current value.
Yeah.
And, of course, we can't forget those accounting scandals from
Right.
the early 2000s. Enron, anyone.
Oh, yeah.
So buckle up, get ready. This is going to challenge what you think you know about finance.
Yeah. It makes you wonder, how many of those financial decisions, big and small, are influenced by these accounting principles that most people don't even know about.
Exactly. So let's dive in. Let's go back, way back to 1936.
Okay.
With the formation of the Committee on Accounting Procedure, or CAP. This was a major turning point for accounting standards in the U.S.
Yeah, the TAP started out kind of small, but things really took off. After the SEC issued accounting series release No. 4, all of a sudden the CAP had this, this implicit authority on best practices.
Yeah.
And their work eventually gave us what we now know as GAAP.
Generally accepted accounting principles.
Exactly.
And these pronouncements from the CAP, they weren't just theoretical, right? They had real-world consequences. Take, for example, FASB Statement Number 106, dealing with other post-retirement benefits, or OPRBs. This changed the game for how companies had to account for things like retiree health care.
Yeah. Before Statement Number 106, a lot of companies, they just used this pay-as-you-go approach, for OPRBs. So they'd only record the expense, when they actually paid it out.
Right.
But this new standard forced them to switch to an accrual basis, which meant they had to acknowledge the full cost of those future benefits as employees earn them.
That must have been a big shock to the bottom line for a lot of companies.
Yeah.
I mean, did this lead to any tough decisions?
Absolutely.
Did they consider cutting back on benefits or, passing on the cost?
It was a financial bombshell for sure. And some companies, they did cut back on those retiree benefits.
Yeah.
And others looked for ways to offset those increased expenses. And it just highlights, how these accounting standards, they can have this ripple effect, far beyond just the balance sheet.
It makes you think about, your own retirement planning, right?
For sure.
Like how these decisions can impact something like healthcare benefits down the line.
Yeah, it's a good reminder that accounting isn't just about, numbers on a page.
Yeah.
It's about people's lives. It's about their livelihood.
So as GAAP continued to evolve, we see the Financial Accounting Standards Board, or FASB, stepping onto the scene. They've been kind of calling the shots on those accounting pronouncements ever since, shaping the way companies prepare their financials.
And these pronouncements, they come in a few different varieties. There's the Statements of Financial Accounting Standards, or SFACs, and those lay down the rules for, specific accounting methods and procedures.
Like the rules of the game for GAAP.
Exactly.
Then you have the Statements of Financial Accounting Concepts, or SFEs, and these are more like overarching principles or guidelines.
They set that conceptual framework for GAAP. Think of it like the Constitution that guides the development of those specific rules.
So why do we care about all these pronouncements? Like, what's the significance for someone trying to understand finance?
Well, understanding these distinctions helps you navigate this complex world of GAAP. You can see how accounting standards are created, how they evolve, and how they ultimately impact a company's, financial reporting. It's like peeking behind the curtain.
Right.
You see how the sausage is made.
Okay, that makes sense. And then there's the FASB Accounting Standards Codification, or ASC. That's where all this guidance comes together, right?
Yeah, that's right. It's the official source for U.S. GAAP,
Yeah.
bringing all those pronouncements together.
Okay, so we've traced this evolution of accounting standards, and we see how they have these real-world impacts. But the accounting world, it hasn't always been smooth sailing, right?
Right.
The early 2000s, that brought a wave of accounting scandals that, really shook confidence in the system.
Oh, yeah.
And Enron is a prime example.
Absolutely.
They used special purpose entities, or SPEs, to manipulate their financial statements and obscure their debt levels.
Right. They use these SPEs
Yeah.
to, keep massive debts off of their balance sheet. They wanted to create this illusion of financial strength.
Yeah. It's mind-blowing how they pulled it off for so long. And Enron wasn't alone.
Right.
This era saw a string of similar scandals that really exposed those vulnerabilities in the accounting system.
Yeah, and these scandals weren't just about, corporate greed.
Right.
They also reflected that changing landscape of the global economy, the rise of service industries, increasingly complex financial instruments.
Right.
Created these new challenges,
So it raises a question. Could these scandals have been prevented?
That's the question. Yeah.
Is it possible to create a system that's truly resistant to manipulation, especially as things get even more complex?
It's tough. There's no easy answers, right?
Yeah.
It's not just about creating more rules. It's about, fostering a culture of ethical behavior.
Right.
Professional skepticism, commitment to transparency.
Yeah. And that brings us to the next chapter in our deep dive. The role of international accounting standards. The rise of those multinational corporations and global trade has created this need for more, harmony in those accounting practices, worldwide. That's where the International Accounting Standards Board, or IASB, comes in.
Yeah, they're like the global FASB.
That's I know what I was thinking.
Working to create this common language for financial reporting, across borders.
Now, the U.S. uses GAAP, but there's been this discussion about adopting IASB standards for U.S. companies as well. What's your take on this push for convergence?
It's a complex issue, really.
Yeah.
Valid arguments on both sides, Supporters argue that it would simplify things, for those multinational corporations, make it easier for investors to compare companies, across borders.
Yeah.
But critics worry about the potential costs and complexities for businesses that are used to GAAP.
It sounds like there's a lot at stake. I want to explore this, later on. But before we move on, there's this interesting figure in our source material, an accounting theorist named Scott. He argued that accounting has to constantly adapt,
Right.
to a changing environment.
Yeah, Scott's insights are crucial, I think, for understanding how accounting has evolved.
Yeah.
He recognized that it can't be static, It has to respond to these new economic realities.
It's not just about crunching numbers. It's about constantly reevaluating and adapting to keep pace with this rapidly changing landscape.
And that's what makes it so fascinating. It's a dynamic field, constantly evolving to reflect the complexities of the business world.
So we've covered the history of GAAP, explored those accounting scandals, and touched on this push for international convergence. Where do we head to next in our accounting adventure?
Well, next we'll dive into how accounting research really shapes our understanding of this field. We'll explore different, research methods and influential theories, like the efficient market hypothesis.
The efficient market hypothesis.
Which has had a big impact on accounting practice.
I've heard of it, but I've never fully grasped it, so I'm really curious to see how it connects to accounting.
It's a fascinating concept,
Yeah.
Challenges some of our assumptions about how markets work, how information is reflected in stock prices. Get ready for some thought-provoking insights.
So before the break, we were talking about the efficient market hypothesis and how it shaped accounting research. So can you tell us a little bit more about this theory and how it connects to accounting practice?
The efficient market hypothesis, or EMH, basically says that stock prices, they already reflect all the available information.
Okay.
So in theory, that means you can't consistently beat the market. Right?
Yeah.
Because any new information, it gets priced in like that.
So if the market is really efficient, then what role does this accounting even play?
Right.
I mean, wouldn't all that financial information be irrelevant if the market already knows everything?
That's a good question. And the EMH, it's been really influential. But it's not without its, critics.
You're right.
One of the key challenges is this idea of limits to arbitrage.
Limits to arbitrage.
Which suggests that even if there are mispricings in the market, it's not always that easy for investors to exploit them.
Because?
Well, there are things like, trading costs, short selling constraints, even just, lack of awareness of that mispricing.
So there could be valuable information hidden in those financial statements.
Right, exactly.
That the market hasn't fully digested.
Exactly.
That makes sense, especially with, the complexity of financial reporting.
And that's where the skilled, analysts and investors come in.
Yeah.
They sift through those numbers, they try to find those mispricings, and then they make those investment decisions, based on their analysis.
So accounting plays this crucial role in providing the raw material, so to speak.
Absolutely.
For that kind of analysis.
Absolutely. And the EMH, even with those limitations, has really, shaped how we think about the value of accounting information.
Yeah.
It really emphasizes the importance of, timely and accurate and transparent reporting, to ensure that markets can function efficiently.
I'm starting to see how accounting and finance are intertwined, right?
Yeah,
it's not just about,
Right.
Crunching the numbers. It's about how they're, interpreted, how they're used
Exactly.
in the real world.
In the real world, right.
Okay.
So let's talk about inventory valuation.
Okay.
You've got some excerpts there that, highlight these different methods for valuing inventory, like LIFO, FIFO, weighted average. And from what I've read, these choices can really impact a company's financials.
Huge.
Can you kind of walk us through those different methods
Of course.
and explain why it even matters? So let's start with FIFO, first in, first out.
First in, first out.
Basically assumes that the oldest inventory is sold first.
Okay.
So in a period of rising prices, like we have now, this means the cost of goods sold will be lower, resulting in, higher profits.
So it paints this more optimistic picture, right?
It can, yeah.
During, inflationary times.
There's another hand.
Yeah.
You have LIFO.
LIFO.
Last in, first out.
Last in, first out.
And that assumes that the newest inventory is sold first.
Okay.
So in, those same rising prices, that's going to lead to a higher cost of goods sold and lower profits.
That seems a little counterintuitive.
Yeah.
Why would a company choose a method that makes their profits look lower?
It's about taxes.
Ah.
Using LIFO can result in lower taxable income during those inflationary periods, potentially saving the company money on taxes.
So it's a strategic decision.
Absolutely.
Right. They're balancing the financial reporting with tax optimization.
Exactly. Companies really have to, weigh those trade-offs between those different methods, and choose the one that best aligns with their financial goals.
Now, switching gears a little bit, let's talk about the statement of cash flows.
Okay.
It seems pretty straightforward, just tracking the cash coming in and going out of a business.
Yeah.
But are there any nuances I should be aware of?
Yeah. The statement of cash flows, it really is about tracking the cash, but it's more than just looking at, the bank balance.
Okay.
It really categorizes those cash flows into three main activities.
Yeah.
Operating, investing, and financing.
So it gives you a more complete picture
Exactly.
of a company's, financial health.
You got it.
So it's not just about how much cash a company has, it's where it's coming from and where it's, going.
Exactly. And the statement of cash flows can reveal a company's, ability to generate cash from its core operations.
Right.
Invest in its future growth, manage its financing activities.
For example, a company could be profitable on paper, but struggle to generate cash, right?
Oh, really?
That would be a red flag.
Big red flag. Could be. Underlying problems with their business model.
Yeah.
Or their ability to collect, payments.
So the statement of cash flows provides this different lens, I guess, through which to view, a company's financial performance.
Exactly. It's an essential tool for investors.
Yeah.
Looking to assess a company's liquidity, solvency, its financial flexibility.
Now, I understand there are two main methods for preparing the statement of cash flows.
Yeah.
The direct and the indirect methods. So what's the difference?
The key difference is really how they present those cash flows from operating activities.
Okay.
The direct method actually lists those, cash inflows and outflows, so it gives you a more, granular view.
Okay.
The indirect method starts with net income and then adjusts for those non-cash items.
So the direct method is more transparent, but more complex.
Right.
Whereas the indirect method is simpler, but might, obscure some of those details.
You got it. While the indirect method is, more commonly used, there's this push for more adoption of the direct method.
Yeah.
Because it really offers that, clearer picture of a company's cash-generating abilities.
Transparency, that seems to be this recurring theme in accounting. The more transparent the reporting, the better equipped investors are to make decisions.
Crucial. Builds trust and confidence. So now let's dive deeper into those fair value measurements.
Okay.
That we, touched upon earlier.
Fair value, I'm intrigued by it because it seems to be popping up, everywhere. It has.
Yes. Its use has really expanded in recent years, driven by, the complexity of these financial instruments and this need for more relevant information.
So fair value, it's all about determining the current market price.
Right. Yeah, basically.
Like, what would this be worth if I sold it today?
Exactly. It's a market-based measurement.
Yeah.
So it reflects that price that will be received, to sell an asset or paid to transfer, a liability in an orderly transaction between market participants.
But as we said before, determining that fair value, it can be tricky, especially for, those assets that aren't actively traded.
Right, which is why the FASB, they've established this hierarchy for fair value measurement. It ranks the quality and the reliability of the information used.
So it's like a tiered system where some inputs are more reliable than others.
So you got level 1 inputs. Those are the most reliable based on, readily observable market prices. Think, like actively traded stocks or bonds.
Okay.
Then you have level 2 inputs. This is still observable, but they might not be for identical assets, so you might need some adjustments.
Okay.
And then there's level 3. Those are the least reliable. Often based on unobservable inputs.
Yeah.
And a company's own, judgments.
So as we move down the hierarchy, that subjectivity
it increases.
And the potential for, manipulation or bias.
It grows,
Grows.
And that's why transparency and clear disclosure are essential when it comes to those fair value measurements.
Okay.
So all this talk about fair value, those market prices, raises this question. How do companies account for assets that they've, built themselves?
Right.
Like a factory or a piece of equipment.
Yeah.
Well, for those self-constructed assets, companies typically capitalize those costs incurred, right, to build the asset.
Okay.
Things like materials, labor overhead,
Yeah.
aligned with the historical cost principle.
So they're adding up all those expenses, right, that went into creating the asset.
Right.
And they're recording that as the initial value on the balance sheet.
Exactly.
So it gives you a reliable measure, although it might not always reflect, the true economic value if the market value ends up being higher. It seems like there's this constant tension in accounting between objectivity and relevance.
Yeah.
Right? Historical cost.
Yeah.
It's objective, but it may not reflect that, current value, fair value, is potentially more relevant, but can be subjective.
Yeah, you've hit the nail on the head. That tension is, a key challenge in accounting.
Yeah.
It's something that, standard setters and practitioners, they're grappling with all the time.
Okay, so we've explored, fair value measurements and how they relate to those different asset types now. I want to dive into those long-term assets, specifically property, plant, and equipment.
Okay.
Those are some of the biggest items, right?
Huge.
On a balance sheet.
Yeah, these assets, also known as PP&E, they represent, significant investments for companies.
Yeah.
And they play a crucial role in, generating revenue and profits.
So how do companies account for these long-term assets?
Well, accounting for PP&E, it involves several key principles.
Yeah.
Recognition, measurement, and depreciation.
Okay.
So recognition, that's, when a company decides to record an asset on the balance sheet.
Sure.
And for PP&E, an asset must be probable of providing, future economic benefits.
Yeah.
And its costs can be reliably measured.
Sure.
And then you have measurement, which involves determining that initial value of the asset, which, under historical cost, includes all those costs necessary to get it ready for use.
So it's not just the purchase price, right? It's any costs related to, acquiring and preparing it.
Exactly.
For use.
And then there's depreciation.
Depreciation.
Which is, the systematic allocation of an asset's cost over its useful life.
Okay.
Because we're recognizing that. It's diminishing, in
That-
value over time.
So like spreading the cost of the asset over the period it's expected to be used.
Exactly. And depreciation, it's, a non-cash expense.
Yeah.
Meaning there's no actual outflow of cash.
Yeah.
It's a way of matching the cost of the asset with the revenue it helps generate.
But how do companies determine that, useful life?
That's a good question.
And are there different methods for calculating depreciation?
Yeah. Determining useful life, it involves wide judgment, estimation.
Mm-hmm.
You got to consider wear and tear, obsolescence, industry norms. For the methods, there's the straight line method, which, allocates an equal amount, each year.
Mm-hmm.
And then there's, accelerated methods, which, front load the depreciation expense.
So the choice of that method can impact, companies' earnings and potentially their tax liability.
Absolutely. Another example of how those accounting choices can have these ripple effects.
What happens when, an asset's value declines significantly? Do companies adjust their accounting to reflect that decline?
They do. When there's evidence that the asset's value have been impaired, meaning its fair value is less than it's a carrying amount, then, companies have to recognize an impairment loss.
So like taking a hit on the income statement,
Right.
acknowledging that the asset isn't worth, as much as previously thought.
Exactly. The balance sheet reflects, the true economic value, even if it means recognizing that loss.
Okay, so it's all about providing that faithful representation, of the company's position.
Of their financial position, yeah.
So we've talked about, valuing these tangible assets, right? Like buildings, equipment. What about intangible assets? Things like, patents, copyrights, brands. How do you put a price tag on something, that doesn't have a physical form?
That's a great question. And valuing intangible assets is a complex undertaking.
Yeah.
Intangible assets can be much harder to value, than those physical assets.
Yeah.
Because their worth is tied to, future potential.
Right. Or market perception.
Well, how do you measure the impact of a company's, reputation?
Exactly. And there's a lot of subjectivity involved.
So walk me through, the basics. How do companies account for intangible assets?
Well, first, we got to figure out, if it even qualifies to be on the balance sheet.
Right.
So to be recognized, it has to be identifiable.
Yeah.
Meaning you can separate it from the company and sell it.
Okay.
Transfer it. And it has to be probable that it'll generate future economic benefits.
So a company's secret formula, like for a product or something, that would probably qualify.
Right.
But, just a general sense of goodwill in the community wouldn't, because it's not really separable.
Yeah. Once an intangible asset is recognized, it needs to be measured.
Okay.
So intangible assets that are, acquired through a purchase, they're initially recorded at their acquisition cost.
Just like property, plant, and equipment.
Exactly. Okay. But what about those intangible assets that are, developed internally, like a brand built through, years of marketing?
That's where it gets,
real tricky.
Under GAAP, companies, they generally can't capitalize those costs of internally generated intangible assets, like brands or customer lists.
So even if a company invests, millions in building a brand, they can't record it as an asset.
That's right. It's considered too difficult to measure, reliably.
So that creates this situation where a company's balance sheet doesn't really reflect its worth.
Right, especially for companies in industries where, those intangible assets are key.
Yeah, it does seem like there's this disconnect between the, accounting rules and the economic realities of businesses.
There's, a lot of debate about how to, better account for those internally generated intangible assets.
Okay, so there are these limitations on internally generated intangible assets.
Right.
But those acquired intangible assets are treated more like, tangible assets.
Exactly. So they're recorded
at
their acquisition cost, including, the purchase price, and any directly attributable costs.
But unlike, those physical assets, most intangible assets, they don't really wear out.
Right.
So how do we account for that decline in value?
That's where amortization comes in.
Amortization.
Yeah, it's, similar to depreciation.
Right.
But it applies specifically to those intangible assets with a finite useful life, like a patent.
Okay.
It's a systematic allocation of the asset's cost over its useful life.
So if a patent has like a 20-year life, you spread the cost.
Exactly. And amortization, like depreciation, is a non-cash expense.
Okay.
And it recognizes the gradual decline in value as the asset, is used to generate revenue.
What about those intangible assets that don't have a finite life, like, a brand reputation?
Intangible assets with an indefinite useful life, they aren't amortized.
Okay.
Instead, they undergo this impairment test, at least annually, to make sure that the carrying amount isn't higher than its fair value.
So it's like a checkup, I guess.
Exactly.
To see if, the brand has lost value.
Exactly. And if that fair value is lower than the carrying amount, the company's got to recognize an impairment loss.
Right.
And that reduces, the asset's value.
Okay, so even those, indefinite-lived assets, they need to be monitored.
Oh, yeah.
And reevaluated.
They can fluctuate a lot depending on, market conditions, competition, technological changes.
Now, there's one intangible asset that, always has a bit of mystery. Goodwill.
Yeah.
How do you measure an account for something as intangible as, a company's reputation?
Goodwill is definitely, unique and often misunderstood. It arises when, one company acquires another for a price higher than the fair value of its identifiable net assets.
Right. So they're paying a premium, basically, recognizing that the value goes beyond just those tangible assets.
Exactly.
So Goodwill represents that excess payment.
Right.
And it's meant to capture, the value of synergies, brand recognition, customer loyalty, things that contribute to, the earnings potential.
Putting a price tag on the secret sauce.
The secret sauce, yeah.
And while Goodwill, it is technically an asset.
Right.
It's treated differently than other intangible assets.
Okay, so it doesn't get amortized like a patent.
It doesn't. Goodwill is not amortized.
Okay.
It's also subject to that impairment testing.
So like other indefinite-lived assets, it needs to be checked to make sure that the value hasn't declined.
And impairment testing for Goodwill, that involves estimating the present value of future cash flows, which can be, complex, a lot of assumptions, a lot of judgments involved.
So it can be subjective and potentially, prone to manipulation.
It can.
If those assumptions and judgments aren't carefully considered.
Right, which is why transparency and those clear disclosures, they're so important.
So this has been a fascinating deep dive into those, long-term assets.
Yeah.
Tangible and intangible. We covered a lot of ground here from, depreciation, amortization, impairment testing, the complexities of Goodwill. It's amazing how accounting provides this framework for understanding the value of these assets that, contribute to a company's, long-term success.
It is. It really helps us make sense of these complex assets and, their role in generating those future earnings.
Now, before we wrap up our accounting exploration, I want to step back and reflect on something, we discussed earlier, the role of accounting in financial markets.
It's a crucial role. Accounting provides the information that investors and creditors, they rely on it.
We talked about, earnings quality.
Right.
And how important it is to look beyond, just the bottom line.
Exactly.
Really assess, the sustainability, the reliability of those earnings.
High quality earnings.
Yeah.
They're sustainable, they're predictable, and they reflect a company's underlying economic performance.
Yeah.
Investors need to be wary of, those low quality earnings that might be, manipulated or unsustainable.
And we can't forget about, earnings management.
Yeah.
Where companies use those techniques to present a more favorable picture.
Yeah. And earnings management, it can range from, aggressive choices to outright fraud.
It just highlights the importance of, being a skeptical reader.
Right, exactly.
Kind of dig in to the details.
Understand. The true story.
Okay, now shifting gears a bit.
Okay.
I want to talk about this distinction between debt and equity.
Yeah, that's
Yeah.
fundamental, right?
Yeah, seems like it, yeah.
Companies use a mix of debt and equity to, finance their operations.
Yeah. So debt represents those borrowed funds, right?
Right.
That have to be repaid with interest, while equity represents ownership in the company.
Exactly.
So debt is like taking out a loan, and equity is like selling a piece of the company.
Good analogy.
Yeah.
And each option has its, pros and cons.
What are some of those, key factors companies consider?
Well, debt financing, it can give you access to a lot of capital, and it often comes with those tax advantages.
Yeah.
Because, interest payments are usually tax deductible.
Okay.
But debt, it carries that burden of, those fixed interest payments.
Yeah.
And the risk of default.
So debt can be powerful for growth, but it comes with risks.
Yeah, equity financing, it doesn't require, repayment like debt.
Right.
But it dilutes ownership, because those investors, they become part owners.
So it's a balance between control and risk.
It is.
And how does accounting fit into this?
Well, accounting plays this, crucial role in classifying and reporting, a company's debt and equity.
Right.
To make sure there's transparency and helps those, investors and creditors assess the risk.
So accounting paints this clear picture of the company's, capital structure.
Right.
And its reliance on debt versus equity.
Exactly.
Now, things can get a little fuzzy when we talk about, hybrid securities, like convertible bonds. These are, debt instruments that can be converted into equity.
Yeah.
So how do companies account for those?
Hybrid securities, they can be challenging to account for. They have characteristics of both.
Right.
The accounting treatment really depends on those terms.
Yeah.
And whether it's, deemed to be more like debt or equity.
So it requires careful analysis.
It does.
And that classification can really impact, those financial ratios.
Oh, yeah.
I'm starting to see how accounting isn't just about, applying the rules. It's, it's an art.
It is.
As much as it is a science.
It's both.
Speaking of complex transactions, how does accounting help us understand mergers and acquisitions?
Well, accounting provides this framework for recording and reporting on those business combinations. One of the key methods is the acquisition method, and that focuses on identifying the acquirer and recognizing those assets and liabilities at their fair values.
Well, it's like taking inventory, right?
Exactly.
Of everything they bring to the table.
And any difference between, that purchase price and the fair value of those identifiable net assets is recorded as goodwill.
Goodwill.
There it is again.
Pops up everywhere.
It often plays a big role in those business combinations.
So it's like, recognizing that the acquired company, it's worth more than just the sum of its parts.
Exactly. Now, before we wrap up, I want to emphasize the importance of ethical conduct.
That's a good point. Accountants, they hold this position of trust.
Absolutely. The AICPA Code of Professional Conduct, it outlines those ethical standards, things like integrity, objectivity, independence, due care, confidentiality.
So it's not just about, following the rules, it's about acting with integrity.
It is.
So we've covered a lot in this deep dive.
We have.
From the evolution of GAAP to the intricacies of, valuing those assets, earnings quality, the ethical responsibilities of accountants.
It's been quite a journey.
Yeah, it's clear that accounting is more than just crunching numbers.
It really is.
It's a language that helps us understand those financial stories.
It does.
A huge thank you to you for guiding us through this complex world.
My pleasure.
And to our listener, remember that learning about accounting, it's an ongoing journey.
It is.
Keep exploring, keep questioning, keep digging deeper.
Exactly.
Until next time.
Happy accounting.